Thank you for joining me on this video. My name is Rodney Constable. I am the president and founder of Simple Market Signals at simplemarketsignals.com. Simple Market Signals helps you understand the level of risk in the stock market through our proprietary market risk signals that are emailed to you every weekend in our weekly stock market-based newsletter, all for less than $20 per month. Today we will be doing technical analysis on the S&P 500 for the week ending Thursday, July 2nd. 2020. The market is closed today, actually, when I'm making this video on the 3rd of July in observance of Independence Day here in the United States, which of course is July 4th. For this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. For the week, we were up 4.02% on the S&P 500 and closed at 3130.01. This first chart that we're going to look at is a year-to-date weekly candlestick chart of the S&P 500. The orange line is the 40-week moving average, and the blue line is set at 3,000 on the S&P 500. We had a pretty good week. In only 4 days of trading, we were up 4%, so an average of just a little over 1% per day, so not too bad for the week. And as we can see here, we have now closed 6 weeks in a row above 3,000 on the S&P 500. So that 3,000 level is extremely important, and 5 out of the last 6 weeks we have managed to close above the 40-week moving average. Last week we did dip below it at the end of the week, but this week jumped right back above it. So far so good. We continue to close above the 40-week equivalent to the 200-day moving average, and we continue to close above 3,000 on the S&P 500. So that is all very positive. This chart is a 4-day, 5-minute candlestick chart, so each candlestick represents 5 minutes of trading. And as we can see here, Monday through Thursday, pretty good week here. Thursday, of course, we gapped up and then closed towards the lows of the session, but still managed to be up 0.45% on the S&P 500, even though we closed at the lows of the session. We were still up almost 0.5% on Thursday, and again, averaged about 1% per day Monday through Thursday, for a total of a little over 4% increase on the S&P 500 over the last 4 days. And this week was basically the exact opposite of last week, where we had Monday and Tuesday were pretty good, but then Wednesday, Thursday, and Friday sold off, and we closed at the lows of the session for the previous week. And when we look at the price action of the S&P 500 for Friday, June 26th, and then Monday, June 29th, on this 2-day, 2-minute chart, so each candlestick represents 2 minutes of trading, what I thought was so interesting is we came down just before 10 o'clock on Monday and just kissed for less than a minute. Hopefully you can see where my cursor is moving inside of that blue circle, but we just came down and kissed for less than a minute the 3,000 line on the S&P 500. So it shows just how important this 3,000 level is to the S&P 500. So fingers crossed, we need to continue to close above 3,000 on the S&P 500 to keep this trend intact. But if we do start to close below 3,000, that should be a heads up to all of us that something is changing. But look at that. Came down and just kissed that 3,000 level for less than 1 minute. And then for the rest of the week, of course, rallied forward. So pretty interesting. On this chart, what we're looking at is the last 9 days of trading. So the last 2 weeks of trading, of course, Friday the 3rd, the market is closed here in the United States. And so this is a 10-minute candlestick chart of the S&P 500. And what we can see here is that this week, we basically reversed what we lost last week. And where we closed on Thursday is just slightly below where we closed on Tuesday the 23rd. So over the last couple of weeks, we've made a little bit of progress, forward progress, but not a lot. But there has been a lot of volatility in the market over the last 2 weeks. And this chart is a 1-month hourly chart of the S&P 500. So we're going back to June 3rd. And as we can see here, for the month, we've had a tremendous amount of volatility. Really haven't made a whole lot of progress on the S&P 500, up about 30 points from where we opened. As you can see here, we opened at around 3,100. On the S&P 500 on June 3rd, and we closed right at 3130. So made about 30 points of progress for an entire month, but we've had a tremendous amount of volatility. So a lot of sideways and volatile price action in the S&P 500 over the last month. Now what we're looking at is a 3-year weekly candlestick chart of the S&P 500, and the blue line is a trend line that I've drawn across the peaks in the market for 2018 and the beginning of 2019. And of course, we know that we exceeded that trend line for several months towards the tail end of 2019, and then that failed. And what we can see here, look at this. We stopped this week. We stopped right at that trend line again. So we broke above it a few weeks ago, but again, that failed, and we went right up to that 3,200 level. So this trend line, guys, I feel it's very important. I believe that this was an aberration, an anomaly. So far the technicals have proven me right, because we kept stopping at this trend line through 2018 and the first part of 2019. We had this big rally that got way above it, of course, hit our all-time highs on February 19th at 33.8615, and we know what has happened since. And as we've tried to get up and stay above this trend line, that has failed. So far, this trend line is telling us that this is kind of the upper boundary for the market for now. Now, only time will tell whether we can shift into another gear and start to close above that trend line. But so far, this trend line is causing us fits. And we can see this week we stopped right at that trend line. So just another data point for us to keep our eyes on. Now what we're going to do is look at a few other charts besides the S&P 500 to kind of get an idea of what is happening in the overall investing environment, both here in the United States, and we'll take a look at a worldly chart as well. We're going to start off here with the DIA, and this is a 5-year weekly chart of the DIA that tracks, that's the ETF that tracks the Dow Industrials, the 30 stocks that are in the Dow Industrials. And what we can see here is we are not seeing relative strength out of the Dow Industrials. They continue to close on this ETF, this DIA ETF. It continues to close below its 40-week moving average. So we are not seeing strength out of this part of the stock market. Now what we're looking at is a 5-year weekly chart of the MDY, which is the ETF that tracks the S&P 400 Mid-Cap Index. And as we can see here, mid-caps continue to trade and close beneath their 40-week moving average. Now what we're looking at is a 5-year weekly chart of the IWM. The IWM is an ETF that tracks the Russell 2000 Small Cap Index. And as we can see here, small caps continue to trade and close beneath their 40-week moving average, just like the DIA and the MDY. So we are not seeing relative strength in a lot of areas of the economy and the stock markets, guys. There's very few things that are working right now. Small caps are not working. The DIA is not working. Mid caps aren't working. And furthermore, and I've pointed this out in my other videos, but I want to repeat this. It is really, really hard to have a really strong stock market without small cap participation. And of course, the Russell 2000 is a great representation of the U.S. small cap area, the index there. And as we can see here, back in 2016, we got above and stayed above for a very long time, and throughout most of 17, and then throughout a good portion of 2018, we stayed above the 40-week moving average. This is what we're looking for. We need to get above and stay above that long-term trend in the small caps, and that will tell us that we've got a pretty strong overall stock market. But look at this. The IWM, the Russell 2000 Index, peaked back in August of 2018, almost 2 full years ago. Now, we rallied at the beginning of 2020 and tried to get up to that level again, but we couldn't quite close above the highs that we made in August of 2018, so we failed. This rally attempt failed. We fell short, got really close, but fell short. And here we are, trading at levels that we first saw back in 2017. So I know there's a lot of optimism out there about the stock market here, guys, but I hope you're seeing through these charts that we've still got a lot of wood to chop. There's still a lot of progress to be made. We are not seeing strength in many areas of the stock market. Now, the one place that has been working has been large cap tech. And now what we're looking at is a 5-year weekly chart of the triple Qs, okay, which tracks the NASDAQ 100. And as we can see here, the NASDAQ 100, the triple Qs, made another all-time weekly closing high this week. So this is what's working. But guys, nothing else really is working but large cap tech. So I think the question we have to ask ourselves is this enough to hold up the whole stock market? Can the whole stock market just revolve around large cap tech and, maybe 100 or 200 stocks in the entire stock market? Based on my decades of being in the stock market, of investing, trading, working as a financial professional, the answer I come up with is no. Okay. So I think we need to be careful here, and we need to understand this massive divergence that we're seeing in the performance of one area of investing, which is large cap tech. That's doing pretty well, but things like small caps are not doing well at all. Okay. So we need to understand this. We need to really take this at heart. The stock market is trying to tell us something. And I'm not trying to encourage everybody to go out and invest in large cap tech. That's not the point. I'm trying to point out that I believe there's more risk in this market right now than most people understand, believe, and are accepting. Okay, so we need to be careful here. And then when we look beyond the United States, now let's take a look at the MS World ex-US Index. So this basically tracks the entire globe, over 1,000 holdings, well over 20 different countries, excluding the United States. And what we can see here is this index peaked at the beginning of 2018, and we continue to close in the MS World ex-US Index. We continue to close beneath the 40-week moving average. So I hope you're seeing here, guys, that we need to be careful, okay, because there's still a lot of weakness all around the globe in stocks. Now what we're looking at is a chart of the S&P 500 for the first 3 months of 2020, so January through March. And I've annotated this chart with the simple market signals to show you how simple market signals can help you understand the risk levels and the changing risk levels in the stock market, and how simple market signals can help you manage your risk. The simple market signals are green, yellow, and red. Green is the lowest risk level in the stock market. And what you're going to find is the stock market makes most of its upward progress when the signal is green. When the signal is yellow, that means that risk levels are starting to rise. And what we can expect in a yellow environment is sideways to slightly up or down price action. And the red signal is the worst signal in the model. And you're going to find that the worst sell-offs, including bear markets, happen when the signal is red. So let's walk through this and see how this works. So we came into the year with a pretty strong stock market, as we know, and the signal was green for the majority of January of 2020. On the 27th, the signal went to yellow, and we had a yellow signal for about 2 weeks here. As we can see here, the signal went back to green for a few weeks. We know that we hit our all-time high in the stock market on Wednesday, February 19th, 2020, where the S&P 500 closed at 3386.15. And then we had this negative reversal that I had talked about in my newsletter to my subscribers, and I had told them that I did not like this price action because we did not have the follow-through. We hit that all-time high in the stock market, and then we had this negative reversal, sold off on Thursday and Friday. And so in the newsletter that went out on Saturday, February 22nd, I was warning my subscribers that I felt like something was changing and that they should be ready to take defensive measures and protect profits. And sure enough, the signal went yellow on Monday, February 24th. So I hope you guys are paying attention to how this can really help you manage your risk. And think about what happened here, okay? We hit an all-time high in the market, and then just a few days later, the model showed that there was rising risk, and the signal went yellow on the 24th. Now, over and above the risk signals, I have trend indicators in this model, okay? So there's numerous things going on, but the trend indicator called the longer-term trend indicator called the general trend indicator went negative the very next day on 225, okay? So the signal went yellow, right, on Monday the 24th. On Tuesday the 25th, the general trend indicator went negative. So there's two warnings right there, right, that something is not right in the stock market. And by the way, the general trend indicator had been positive since October of 2019, okay, since early October 2019. So think about that. The signal went yellow. The very next day, the trend indicator went negative. That trend indicator had been positive for months, okay? So there's numerous ways that simple market signals can help you manage your risk. So there's two things right there within 2 days that could have told people that they probably should take some profits, rebalance their portfolios, take defensive measures, buy puts, however you want to protect your portfolio, right? That's up to you. But you can see here how this is working. And then by Thursday, the 27th, the signal had gone red, okay? And by the way, that signal went red at around 3,000 on the S&P 500. And your first warning came out at about 3,250, okay? So, and the second one came out somewhere, around 3,100. Let's just call it 3,100. So you had numerous warnings all within 1 week. You had a yellow signal. You had a negative general trend indicator. Again, that thing had been positive for months. And then the signal went red. And as we know, the market sold off very hard from there. Guys, this is just one example, but a very recent example of how simple market signals can help protect you, okay? And regardless of whether you're trading the S&P 500, the DIA, the triple Qs, individual stocks, the correlations in the stock market they're so high these days that if you understand what's going on with the S&P 500, and my model is based on the S&P 500, but if you can understand what's going on with the S&P 500, irrespective of what you're trading, it will help you understand the general direction and the general risk levels in the stock market, okay? Because as we know, 70, 80, 90% of all stocks go in the same general direction as the S&P 500. So if we can understand what's happening with the S&P 500, it gives us a huge advantage in trying to manage our risk and protect our profits with our investments. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. If you are a financial advisor or an individual investor that manages any of your own money, including in your 401k, 403b, your IRAs, or of course your trading account, I would encourage you to take a serious look at Simple Market Signals, which is my personal risk management model that I have now made available to the public. For those of you who would like to learn more about how Simple Market Signals can help you in both up and down markets, here's some additional information. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in this Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signal subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy.